We are going to do 3 stocks today that are 8 pillar stocks. If you're new to this channel, I'm Paul. I'm a value investor. I use the 8 pillars as a way of screening for my plays. If it has all 8 check marks, it doesn't mean I buy, but my goal is to buy $1 for 70 cents. So let's go look at this and understand more about the 8 pillar process. So first stock that we're going to look at right now is going to be Phillip Morris. Ticker symbol PM. So if you have our software, guys, follow along. It's a great way to get used to it and understand how to use the process over and over. So Phillip Morris, it's the tobacco company, of course. It had a high this last year of 112 and a low of 85. Let's see here. Some things that jump out at me. So first off, very, very high gross margin and bottom line profit. So their 5-year profit margin is 26%. Last year they did 28.6, so pretty consistent. And their gross margin is about 2/3. All right, so one of the first things I'm gonna look at is their dividends. This is a very attractive dividend play. I'm sure a lot of you guys look at it going, oh, I love this 5.2% dividend. Remember, dividends aren't always safe. Okay, you have to look at the free cash flow of the business. When companies want to attract investors, they might temporarily increase their dividend by taking on debt or using excess cash in their bank account to pay a dividend to get people excited about the stock and rise and make the stock go up. That is not good. So I want to compare the dividends paid on our software here. We calculated it for you to the 5-year average and the last year's free cash flow. Now, I will say $7.7 billion and their 5-year average is 9. And that's a lot. That's a big chunk of their dividend. However, a company like Phillip Morris probably doesn't have a lot of growth potential. So what can they possibly reinvest in? It might be okay for them to pay out this dividend yield. So one thing I would do is go look at their dividend payout relative to cash flow historically and see how they were able to pay it and they kept paying a high percentage. All right. So let's go look at our 8 pillars here on Phillip Morris. So a couple things. Very low shares outstanding buyback. That's all right. 5-year PE and 5-year price to free cash flow, 18.8 versus 16. Look at this 5-year return on invested capital. We want over 9%. It's 45% here. But the question is, do they have a way to reinvest that capital over and over to start generating more and more profit? That's the question we have to ask. Now, I will say, I'm actually surprised to see this. $1.4 billion in revenue leads to a $2.6 billion increase in net income and $3 billion in cash flow. So you might ask yourself, how can their revenue go up 1.4 and their net income and free cash flow go up higher? Very simple, cutting costs. But let's go check out the income statement to see. Their revenue, look at their revenue. It's pretty stagnant. It's pretty boring and stagnant. And their profit is pretty boring and stagnant. Okay, so you have to ask yourself, this is a tobacco business. Tobacco has a lot of potential internationally still, but in the US, it's declining and declining and declining. In in established first world countries, the use is declining. So what's the future for it? I don't know. This is part of what you need to do. And if you have concerns about it, join the EM community and figure that and talk to people about that. So let's look at analyst estimates for the company. This is a new feature of our site. Earnings per share, analysts see growing from 583 to 765. Keep in mind, number of analysts here, these are not the only analysts in the world that follow Phillip Morris. So other sites might have other analysts with different expectations, but they do still have earnings per share after this year back on the growth path of mid-single digits. Let's go to revenue. Now for the revenue part, analysts are showing after a slight 4% drop this year of getting back to growth. And again, not a ton of analysts, and analysts do have their biases, but I use this as kind of a gauging point of where to go into our stock analyzer tool. So when it comes to trying to figure out how much to pay for the stock, this is why we created the stock analyzer tool. All right. When we were doing this videos 2 years ago, I had an Excel sheet with a data feed, but everybody kept saying to me, Paul, how do I get this analysis you're doing? So we made this website for it. The stock analyzer tool has become one of the most important parts of it as a way of kind of weeding out the bad companies. The future is unknown, and every investment is the present value of all future cash flows. But since we don't know the future, we have to make assumptions. My goal as a value investor is to make very reasonably priced assumptions, very reasonable assumptions, and buy when the stock is selling for below that. There are over 10,000 stocks out there I can go research. Let me go find the 20 to 40 that make the most sense for me. Now, it's a combination of quantitative and qualitative aspects of the business. So on this side, even though there is revenue growth potential for this company, qualitatively, you have to ask yourself, what is the future of smoking? I don't know. I really don't know. But I'm going to make my assumptions based on not knowing and saying, let me be a little conservative and see. So I would recommend that in all three of these companies, you rewind when I do the stock analyzer tool for each company so you can understand it more and more. So revenue growth. I'm going to go with 0, 2, and 4. Profit margin was pretty consistent, as you can see. 26, 26, 28 in the last year, and 26 over the last 10 years. So I'm going to go 22, 24, and 26. And the reason why I went lower is if a product becomes less and less in demand, I assume the company's got to decrease their, either increase their cost or decrease their price in order to generate more demand for it. Okay, so I'm going to assume a smaller, and this is a big drop in profit margin. Now for free cash flow, I'm going to do the exact same thing in terms of my assumptions about it. I'm going to go with 24, 26, and 28. Actually 27 and 30. Now PE. Now I always think that the PE and the price of free cash flow should be based on the moat and the future growth potential. There's probably a very strong moat here with Phillip Morris, but the question is, what is the future growth potential? If the company was going to grow 100% a year, I'd say pay 50, even 100, I'd pay 300 PE. I wouldn't care. It's got amazing potential. But if it's growing at 0, 2, and 4%, what am I supposed to do here? So I'm going to go with 9, 12, and 9, 11.5, and 14. Same with the PE. Same with the price of free cash flow. Now, finally, what is my desired annual return? You can get 9 or 10% by investing in a long-term ETF that's market-based. So in order to give yourself that margin of safety and a reason to buy an individual stock, you should pick a higher price than that. What I like to do is, on the low assumptions I'm being conservative on, I do a lower return. Why? Because a lower return means a higher price. The more you pay for something, the less your return is going to be. They work inversely. And as my assumptions go higher and higher, I want a higher desired return because I want a higher margin of safety. So I'm going to go with 12, 14, and 16%. Now, guys, I'm going to hit the analyze button. 6 numbers going to pop up. 3 numbers for a value based on earnings, low, middle, and high, and 3 numbers based on a value based on cash flow, low, middle, and high. If they're all green, does that mean go out and buy? No. It means go do your research. Figure out if these assumptions are correct. So how do you figure out if these assumptions are correct? Well, guys, this is why we created the community. There are thousands of people in here who have dedicated their lives to value investing. We created this specifically for people who felt alone in the value investing community. I was alone when I first started being a value investor. Then over time, I found other people, and even my biggest level was 3 or 4 people who I talked to. This has thousands of people in it, plus all of these tools to be able to use all of this to figure out your investment strategies. Now, if you can make 1 or 2% a year, or save yourself 1 or 2% a year in losses extra by using these tools, it could lead to hundreds of thousands, if not millions of dollars. And this is all for less than a cup of coffee per day. And I just want to show you guys how it looks compared to what other people have out there. These are all the things you get. You get the mobile app. All of this works on your mobile. 8 pillars, 30 years of financial data, stock analyzer tool, exclusive daily content. We post videos every day just for our users. Access to Seth Mo and I, real estate calculator, stock screeners, retirement calculator, and that big one, the community of like-minded investors. And the other options out there are way more expensive and don't even offer what we offer. It's a no-brainer here. So go to everythingmoney.com to sign up. Less than a cup of coffee per day. You know you can do it. So I hit the analyze button, scroll down below. Okay. So low end, we have about $40. High end, we have about 60. Middle is about 50. All right. So it kind of makes sense based on the lack of growth and the high returns we want. So I'm looking at this going, let me go add this to my watch list at about $55. A little bit above my middle section. That way I'm notified. I'm going to start doing more research when it gets closer to my price. To me, there's no reason to go do research now. It's only at $96. It's got a long way to go. So save yourself some time and don't worry about it yet. Okay, next 2 stocks. LMT, Lockheed Martin. So let's go look at LMT. Now these 2 we're going to do a lot faster because we've already shown you the process. The stock's at 480, 52-week low is 320. Sorry, the stock's at 426, 52-week high is around 480, low is 325. We have a dividend yield about 2.6%, which is about double the stock market right now. Pays out $3 billion a year, which is a little bit higher than the 5-year average I want it to be. It still eats up about 55% of the free cash flow, but based on last year's free cash flow, it's well under 50%. So it's probably looking pretty good. And this is the kind of company with a lot of government contracts. I don't know if there's a lot of growth potential for it. So paying out the profit and dividends probably makes a lot of sense. So let's look at the 8 pillars. All 8 pillars, buying back a few shares, 5-year PE, 5-year price of free cash flow, very similar. Reasonable debt. I mean, it's on the higher side of our goal, but it's still low. They're buying back shares, increase in revenue. Okay. So the only thing I'll say about this company that always concerns me is I don't like being reliant on the government for my revenue. But if you go look at them, I don't think the military is going away, and the government's definitely not going away. So can you argue that this is probably a good thing to look at? I mean, maybe so. Their 5-year average net income is $5.3 billion. All right, let's look at the analyst estimates here. Analysts estimate some pretty good jump in profit. I mean, they're looking at big jumps in profit here along the way. And revenue-wise, not as much a jump, low single digits. So let's factor that in there in our stock analyzer tool. I'm going to stock analyzers. Now, even though the analyst showed increase in revenue, my first one's going to be a decrease, 2%, 0, and then 2%. Profit margin, very consistent. I'm going to go 7.75, 8.5, and 9 point. I'm just going to go, actually, I'm going to do this, 8, 8.5, and 9. Free cash flow margin, same thing. PE, guys, boring company, government reliant, not a lot of growth potential. I'm going super low. I'm going 10, 13, 10, 12, and 14. Same with price to free cash flow. And for my desired return, I'm going to do the same thing I did before. 12, 14, 16. Hit the analyze button. All right, so 150, 200, 175 in the middle. Again, no reason to do any more research. It's too high. Guys, in order for even the top end to hit, for even the bottom end to hit, if you had 4% growth, it would still take a while. You have to do even at multiple of 15 times revenue and profit, you're still not there. You still have to drop to 268 to even make it worth your while. So keep that in mind when you're looking at this. It's not just me picking random. I mean, these numbers are so far away. That's what I want you to realize when you're looking at these stock analyzer numbers. I went and changed all these assumptions to big numbers. Let me go to 6% a year growth. Analyze. It's only 310. It still has to drop another 25, 30% to even get to these assumptions here that I just put in that were insanely high. All right. Final stock, Dillards, DDS. So let's go to home, DDS. Now Dillards. All right. Retail. Oh my Lord, look at this dividend. Jeez, oh Pete. 6% dividend, pays out $300 million a year. 5-year average free cash flow is $450, but that includes last year of almost $1 billion. So that big jump is probably $120 million. That's too much dividend for me. Way too much dividend for me. If the stock is this cheap, they should be buying back shares, not paying it out in dividends. But let's go check out the 8 pillars. Okay, they do have revenue growth, cash flow and profit. Shares outstanding are down 40%. Jeez, oh Pete, very low debt. All right, I mean, look at this revenue, guys. 10 years ago, 6.75. Last year, 6.93. So I'm gonna do something a little bit different I don't usually do on videos. I'm gonna go to their 10K. I wanna see same store sales. Actually, I'm gonna do closed stores. Let's see if there's a list. A lot of times these companies will have lists of stores. Let's see, during fiscal, okay, blah, 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 blah. Let's see here, locations. Let's see here. So what I'm doing is I'm looking through their 10K to find out how many open stores they had, how many closed stores they had. Interesting. Okay, let's go to comparable retail stores. Sales increased 8% compared to 2019. Okay, that's good. Okay. I don't like this. They're not reporting due to COVID-19. Everybody else reported. I don't like that at all. So let's do some scuttlebutt. How many locations does Dillards have? 282 stores in 29 states. Okay. That's from... So what I'm doing here, guys, I want you to see everything that I'm trying to sit there and focus on looking at the data, but I want to see a change. What I'm trying to look for here is what's the change in number of stores? How are they opening? How are they closing stores? Are they closing off less reliable and less profitable locations or ones that even lose money? I don't know if any of you even lose money, but that's the goal here as an investor. You want to sit there and understand as a retail company, what are they doing? Because these are big boxes and mall traffic is changing significantly. So what are they doing to change that? All right. So I was able to find that right now, and I don't want to take up too much time in the video, but that's another reason to join the community and have this conversation. So let's go to our stock analyzer tool. And again, with retail, I'm going to be uber conservative, even though their revenue was up 23% last year. With that 23%, that's the only reason they got to growth over the last 10 years. So let's go -3, 0, and 3% because of inflation. Profit, 4, 4.5, and 5. Free cash flow, 5.5, 6, 6.25, and 7. PE, 7, 9, 11. 7, 9, 11. Guys, these are dying companies. So I want 15% across the board. Retail is tough. I want to buy it when it's a screaming buy. The stock price is currently $297. I put in 15% all over. Actually, it's not as bad as I thought. Probably 100 there. It's actually not too far off there, maybe 225. And then here, about 150. It's not as far off as I thought it was going to be. So again, add this to your watch list. Maybe you add it at 175 here and wait for it to get there and then to do a deeper dive. If you like this video, watch our next video that involves margin of safety, and please subscribe to our channel. Thank you very much for your time.